It's time for our second panel of today about the challenges of European economic, monetary and fiscal policy. The Maastricht Treaty established the European Central Bank, which has as its main objective to maintain price stability. Measures such as hiking interest rates aim at countering the current inflation levels. At the same time, the ECB also looks ahead and wants to adopt climate policies and looks at distributional effects of its policies. In this panel, we will look at the macroeconomic situation, the short and the long-term objectives of the ECB and its mandate. Please give a warm welcome to our speakers, Maria Demertzis, Erik Jones, and Rolf Strauch. Please join me on stage. Welcome. Yes, let me get you maybe a fresh glass of water first. Here you go. We are very happy that you wanted to join us here in Maastricht. Let me briefly introduce you. Rolf Strauch is a chief economist and member of the management board of the European Stability Mechanism, ESM. He is responsible for economic and financial analysis and policies and the country monitoring work that the ESM undertakes. Prior to this, you worked at the European Central Bank from 2000 until 2010 in the Directorate General Economics on fiscal, monetary and structural policies, as well as the Deutsche Bundesbank. Welcome. Maria Demertzis is Deputy Director at Bruegel. She previously worked at the European Commission and the Research Department of the Nederlandse Bank. She also held academic positions at, among others, the Harvard Kennedy School of Government in the US of A. You have also published extensively in international academic journals and contributed regular policy inputs to both the European Commission's and the Nederlandse Bank's policy outlets. Welcome, good to have you. Erik Jones is director of the Robert Schuman Center of Advanced Studies at the European University Institute. He is also professor of European Studies and International Political Economy at the Johns Hopkins School of Advanced International Studies. Erik is also author of several books, including The Politics of Economic and Monetary Union from 2002 and The Year the European Crisis Ended. His commentary has appeared in the Financial Times, the New York Times, and other major newspapers and magazines across Europe and North America. Welcome. Let me start, Rolf, with you, because you are here on behalf of the ESM, a fund established at the height of the euro crisis by euro member states to act as a lender of last resort. What does the ESM actually do right now at this time? I think it's good to explain first before we dive in.
I'm very happy to do that. I was really pleased also to listen into the earlier discussion that you had, because I think there is a lot in this, what you said also about the confidence on the euro and Europe. I think what is for me the key ingredient that also gives me that confidence is that Europe has shown the capability to work on the cohesion of the euro area and of the euro structure overall. And I think we have, the euro exists, and I'm very convinced it will exist in 20 years, because we have added a great deal of resilience to the institutional structure that we have. And here the ESM obviously is an important part. I think the ESM is the crisis resolution backbone of the euro area, and without the ESM, it's true that the euro area in its current form would probably not exist anymore. We are there to lend resilience. We are there and have preserved, actually, in the past crisis, not we alone, but in the conjuncture with other policies, have preserved the integrity of the euro area. And we did this, obviously, by providing money to countries, by providing support to countries. That was a lot of solidarity, and I agree with you also in what you said, that this north-south divide is overplayed. This is about solidarity. I think it was not only for the benefit of the banks, but rather it was indeed for the benefit of the euro area overall. And countries like the Netherlands, countries like Germany, fundamentally understand that it's for the benefit of the country overall to be part of this euro area structure. It's a big part of the economic benefits of the trade relationships, of the financial relationships that provide lasting gains. And that is what needed to be preserved, and that was what was actually preserved. Now, ESM, we are a crisis resolution mechanism. We have a very flexible toolbox. And we have different instruments that we can bring to the benefit of the countries. In the past crisis, it was by way of adjustment programs. And those were partly, of course, very heavy and very tough because those countries needed some realignment to overcome vulnerabilities. But with the pandemic, we have also created another tool that was the pandemic support, which was of a very different nature. And I think there, for example, the difference was it didn't have much macro conditionality because that was not what was the order of the day that needed to be done at that point. So we can shape our toolbox. We have a toolbox that can be adjusted to the needs of the situation. And just the fact that we are there and that we hear very often from investors, the fact that ESM is there actually helps to give confidence, even if the tools are not used. The pandemic support tool was not deployed to a country, but many investors told us, look, the fact that you came in jointly with the European Commission, jointly with the EIB, actually gives a great deal of confidence. And that is what we are there for.
It is said that our economies are facing a perfect storm. Can you explain what does this mean, and can you talk us through the challenges that European economies are facing at the moment?
Indeed, it's a tremendous challenge. The economies are basically facing a double shock. We had the pandemic, we come out of the pandemic, we get into another shock, which is a supply side shock, which comes through what we import, and which is exacerbated by the war. There are two features that matter here. First is the terms of trade shock, where what we import is more expensive than what we export, and that means basically we export income and wealth. On an annual basis, the increase in energy prices has the cost for the euro area of 5% of GDP. This is very huge. It's bigger than what we have experienced in the oil price crisis in the 1970s. So, and that we have to understand, it's a transfer of income and wealth, and it cannot be all compensated. On that one also must be clear. So we have to find a way to mitigate the impact, but not everything can be compensated. The second point is it's a cost push shock. And this is the kind of shock where the supply, the input becomes more expensive. That is always very difficult also for central banks to handle. And we will talk more about this. Mm-hmm. The difference is during the pandemic, monetary and fiscal policy could move in one direction and support the economy more broadly. Now, cost push shocks have this wedge between inflation and growth. So we need a different policy reply to this kind of challenge that we see. But I must also be saying that I don't want to be downbeat on the euro area, on the economics that we see at this stage. There may be a risk of recession, and indeed, there may be a technical recession, but I think there are important reasons why we are actually stronger nowadays than we were in past crises. Labor markets are actually very strong, and we see so far only moderate wage pressure. That is an important thing. We have a better banking system, a safer banking system than we had in the past crisis. That's a big plus. That can help us a lot. We have much less foreign imbalances than we had in the past crisis. That was also corrected on the basis of the programs that we had. So the foreign position from that perspective is nowadays much stronger. And if I'm allowed to make that remark, we also see with the UK how important that is. So here there is indeed a relative strength. So I think there are actually factors that make me also relatively optimistic that even if we have this slump in growth that one can expect, that we have also some measures to contain it. And as a last element, we have also, and we may talk a lot about this later, we have already launched policy initiatives at the European level with Next Generation EU that gives us a transformative tool to actually address the challenges.
Some would argue that Next Generation EU would render ESM initiative obsolete. What would you say to that?
Here we need to understand that both are an expression, I think, of European solidarity, but they work in different fields. The ESM is a crisis resolution mechanism. We are there for stabilization. We are there to give market confidence and step in before countries run into trouble or when they run into trouble to support them. Next Generation EU has also given great confidence to markets. The fact that Europe is able to work with this solidarity, but it has a much longer time horizon. This is about the transformation of the economies. If you want to compare it at the global level, it's a little bit like the IMF and the World Bank, if we want to draw a parallel. And Next Generation EU works more at the level like the World Bank with projects, works on structural transformation towards the digitalization and towards global growth, towards sustainable growth. Model.
Final question for you at this moment. It has already been discussed today in the morning sessions that the ESM would be possible to, in the future, make it more of a European monetary fund, like the IMF, but then EMF. What's your, how do you see the future role of the ESM?
Currently, there is the treaty change ongoing or almost completed that will lead to a further development of our mandate, the ESM mandate. Part of the treaty change is that the ESM will become the common backstop for the Single Resolution Fund. So we are backing up banking union as a backstop. The other point is that our mandate will be broadened in a sense that we have more ownership and more of a say in future adjustment programs when we deploy our facilities in the future. When the past crisis was kicked off, we basically needed to get the IMF on board, and then there was the so-called Troika that formed the policy conditionality of those programs. Forward-looking, this will be done by the ESM and by the European Commission. That will be our role. In that regard, if you wish, we get closer to a European monetary fund. But I think what matters for us, and on that we will be working, and we will stay very attentive, is that we have a toolbox that is geared towards the need of the euro area so that we are prepared to help.
Maria, Greece, your home country, is finally turning the page on its debt crisis with the end to the system of enhanced surveillance last month, a system put in place to allow European institutions to keep an eye on governments' books, ESM being one of them. Did that provide a sigh of relief in Greece?
Oh, absolutely. I think symbolically, if not economically, it was a very big thing. There's actually two things that make a difference in this respect. That is the first one, coming out of the surveillance program. And actually that's politically is also a very big success, as it were. But the second one is when the Greek debt takes investor qualities, when it gets upgraded to the level that it can be considered of investment grade. That's something that is still not there. It's we can talk about this a bit if you like. But I think that would be the second thing that it will make some sort of a normalization of the economic activities back to, let's say, pre-crisis sentiment.
We will come back to you in a minute. First, Erik, can you explain to us, maybe you've been taking notes vigorously. Maybe you want to react on what Rolf has said. Because I see you taking notes, maybe you want to add on that.
So I don't want to react because I don't disagree with anything that he said. I think I would add two things. One is it's not just been an institutional change, there's been a huge behavioral change, particularly in the central banking community. I mean, central bankers now talk about monetary policy much more clearly, much more effectively. So all those things that Roel was saying about these arguments that we should be making, they're actually being made. And I think a good example would be Isabel Schnabel's Jackson Hole speech, where she basically laid out the argument for why monetary tightening had to proceed vigorously. There's a huge amount of political courage involved in that. And I'm not sure that this change of behavior has actually been matched by change in institutions, because there's always the danger that there'll be a political backlash. We haven't seen it on the ECB side, but we've seen it on the ESM side. And this would be the second point that I would make. For all the amazing things that the ESM has done and can do, its reputation is completely divorced from its capabilities. And so when Rolf introduces the pandemic emergency facility that was created, the fact that no one took it up when it was designed to finance health expenditures in a pandemic is meaningful. And I think it's even more meaningful, and this is not something that I think Rolf would want to say, it's even more meaningful when the three parties in government in Italy, or likely to be in government in Italy, are almost genetically committed not to embrace the ESM.
Can you explain why the ESM is so controversial?
I mean, I think it's...
Especially in the southern of Europe.
Well, I wouldn't say especially in the southern part of Europe. I would say, you know, in any place where the political ideology is grounded in the respect of national sovereignty, that the ESM takes on a bad reputation, not because it's a bad institution, but because the conditionality involved is a challenge to national sovereignty. And so if your ideology rejects any challenge to national sovereignty, the ESM is a problem. But I don't say that as a criticism at all. I mean,
if I may, I would just add, the sense is that you don't really go to the ESM unless you absolutely have to. So long as you don't have to, you won't go. I think that is the conditionality element. Now, whether this is true to what the ESM means, and indeed, as Rolf said, the pandemic problem did not have the conditionality attached that other lending had. And yet, it is a reputational thing that people didn't use that. So I totally agree with what Erik said in this respect.
No, sure. Since you're talking about that, I also want to react to it. And obviously, we are not blind or naive in this regard. And yes, one has to acknowledge that countries see a cost in coming to a crisis resolution mechanism. That's an experience that the IMF has for decades, right? And yet, we see that nowadays, there is actually, the IMF is lending more money than in many periods before. So from my perspective, I think there can also be a development. And when you say the countries in the south, just kind of last week, Klaus Regling was in Greece to get a prize, the Lord Bryan Prize, for also his support and the recognition what he has done for Greece. Again, I'm not saying that during the adjustment periods there was no mistake made and everything was easy. Of course it was not. It was very difficult, but there was also the insight that these adjustments to a large extent, or these adjustments were necessary, and that eventually the growth performance afterwards and the performance afterwards helped those countries a lot to achieve the structural change. So from that perspective, forward-looking, again, if we are in a position to provide useful tools for the euro area, we can provide that trust to the financial system, and I'm also confident that at some stage, when there is need, countries will also overcome the stigma considerations.
Good. I want to move on to the ECB, because in light of the rising inflation and the decline of the euro to the dollar, the ECB has decided a few weeks ago to raise its key interest rates by a record 75 basis points. Also, President Christine Lagarde has signaled more tightening ahead. Maria, what does the ECB hope to achieve with these decisions? And what can you say about the timing?
Yeah, so I mean, I think let's start with the numbers. I think because I think they're important. Looking at the inflation forecast that the ECB produced a few weeks ago, we are over 9% this year for the euro area, and next year over 5%. So this is something that will be with us for some time. I always say when I talk about the euro area that the euro area isn't one story. There is many stories, 19 different stories actually. There are countries in the euro area that have got inflation in excess of 10%, close to 50%, others that are about 5 to 6. So there are different stories here, and they have to do, of course, with the underlying economic fabric of each of these countries as well as the policy choices. I think the first thing to say on the inflation, first of all, I don't think the ECB will be reacting to anything to do with the exchange rate. I think the central banks will look only at other things, not the exchange rate. Inflation being the first, of course, because that is the first mandate. But they also look at other things. They look at the growth outlook, and in the European Monetary Union, also in that context, they will be looking at things like financial fragmentation. They care. I mean, I'm sure that the ECB cares about financial fragmentation, meaning that countries have got access to financial markets in reasonable terms. They care about this, even if this is not part of the first part of the mandate. Look, when you have a 9% inflation and your mandate is price stability, which is very far from 9%, you've got to do something. And the question is, when do you intervene and by how much? Up till now, the narrative that came from the ECB was one, look, we don't see it in the numbers, we don't see second-round effects, the kind of things that monetary policy can do something about. The only thing we see is energy. Take away the energy problem and inflation will come back. That was the narrative I'm sketching in rough terms. That's what I think we mean when we say a supply shock. That's basically the definition of it.
But even before the energy crisis, there was a call for rate hikes.
It was before the energy crisis. We still have high energy prices. It wasn't a crisis yet because of the war, but the energy component of inflation was the one that was actually created. So it's all to do with the anticipatory effects of something going to happen. Now, I think what happened now is that we have core inflation, so you take away all these variable components of inflation and you are at about 5%. The ECB has to do something. It's impossible not to do something anymore. But there comes a huge dilemma, and the dilemma is the following. By the time the effects of current decisions will come into effect, we might be away from this crisis. So is it now, and here comes the dilemma that the ECB faces, could it be that we're actually contracting the economy by the time we're going to see those effects? And these are the huge dilemmas that the ECB faces. On the other hand, at 9% headline inflation, 5% core inflation, it's impossible not to do something. I think the public at large do not really understand the difference between what causes the inflation, and it would want to see some policy action. Now, given the uncertainties, the question that I think is important here is when you don't know where you're going, do you want to go there fast or do you want to go there slowly? And I think, given the uncertainties, the transmission mechanisms are maybe disturbed, the war on Ukraine, and all of these issues. Do you want to go there? Do you want to take big steps into something that may actually prove very wrong, or do you want to go sort of more cautiously? And I think the ECB has been playing the cautious game. It cannot afford not to do anything anymore. And of course, we saw the decision of 75 basis points. What I thought was surprising in the previous announcement was not so much that they took this action, but the fact that they say that they're going to take more increases. They're going to make more increases in the future. Now, why do I think this is surprising? They had actually stayed away from, in fact, they have even told us they're not going to play this game of giving us forward guidance. And the fact that they changed that, they found the need to give us forward guidance, means that I think the pressures to do something, to do more of the same, is actually very, very big.
And would it be wiser to, because you say the ECB is taking the cautious path, would you say maybe be more aggressive?
Well, I mean, I think that to answer this question, you have to take a view as to whether, how you feel about uncertainty. I mean, do you want to find out what happens, maybe wait 3 months to see how the war plays out? Could it be that at the end of the year, the war is over? I mean, we don't know any of that. By the end of the year, we have decoupled from Russian energy for the most part. How is that going to play out? How are our energy needs going to phase out? I think these types of elements need to play in terms of the information set that the ECB has in order to react.
I want to go to a TPI, an instrument that was launched earlier this year, the Transmission Protection Instrument, a new instrument that, and I quote, allows the ECB to purchase sovereign bonds issued by countries which face sharp interest rate movements that are not justified given their economic fundamentals and that jeopardize monetary transmission. When and under what conditions will the TPI be activated, Maria?
Easy question.
Or were you hoping for a different question?
Well, no, I think this is a real question. I mean, I think what you just read out is absolutely essential. To the extent that we can tell that the increase in the spreads is not justified by fundamentals, then it makes sense for the ECB to intervene and actually buy the assets of that particular of that country. Now, a very big proviso in this is that the underlying assets are sustainable, meaning that there needs to be a debt sustainability analysis that backs it up. And debt sustainability analysis are not economic analysis; they're totally political analysis. Because if I say that something is sustainable, means I'm going to do whatever it takes to make it sustainable. And in the context of the European Union, DSAs are not, in my view, economic. Primarily, they're political analysis. They require the backing of institutions. I think the economics of it is in my view, is not as important. I think it's the politics that sustains that. Now, what's interesting about that, and the difficulty is that identifying what is justified by fundamentals and what is not justified by fundamentals, and then, of course, answer the question, is the debt sustainable? Yeah, and only then can the ECB do it. Well, there was a very interesting article this week in the Financial Times, and it was argued that actually the creation of the tool stimulates bad behavior, meaning that you have now incentives to do the wrong thing. I totally disagree with that. And the reason why I disagree is because the ECB will not intervene and use this tool if it believes that the country is being uncooperative, or if it believes that the debt sustainability of the country is in jeopardy. And we've had actions. We've seen that the ECB has done that with countries, namely my own, when it pulled the plug on the Greek politicians, simply because it did not believe that this is sustainable. So I do not believe that the ECB is going to go down this way. It just won't do it. It doesn't have any incentive to do that. But it remains a difficult thing, a difficult instrument to operate, precisely because identifying what is justified and what is not is a difficult thing to do. I'm hoping central banks will put a lot of research in identifying the fundamentals versus all the other, sort of the bubbles and the noises that may not justify the intervention.
Rolf.
From my perspective, just to make a point about debt sustainability analysis and how we look at it. I mean, my team is investing quite a lot of time into debt sustainability analysis and doing this properly for the countries that have had a program with us in order to assess repayment capacity, and we're also doing it for market purposes for other countries. So, and I would say that obviously there is always a great deal of uncertainty if you want to predict developments at a 10-year horizon or even 20 years horizon, and you need to work with assumptions. That is true, but nonetheless there is a genuine effort to make this work and do a proper analysis. And that is what we stand for and what ESM wants to do. Then it's obviously always the question, if you go into a political decision-making process, what you make out of that. And eventually, I won't comment on monetary policy, but that will also be obviously the question that the ECB will have to answer at some stage. But I would not say that this is kind of a completely politicized instrument that basically doesn't give any indication. So I think there is serious effort of having this done properly.
Erik, what's your point of view?
So I was listening to Maria, and I was thinking about this as a political scientist, right? Mm-hmm. So you remember OMT, the outright monetary transactions that were created in 2012 to save countries like Italy. The requirements for getting access to support was the country had to remain in the market, it had to ask for support, and it had to participate in some kind of conditional program monitored by the ESM. And then, if those three criteria were met, the ECB's Governing Council would nevertheless make a discretionary choice as to whether to offer support. And it was never quite clear what the discretionary choice would be. The thing that makes me nervous about the TPI is that the country doesn't have, at least in my reading of the country doesn't have to ask for support.
That's right.
The country doesn't have to be in a program. The country is already in a program notionally because they're participating in Next Generation EU, so there's a conditionality requirement that extends to all the fiscal rules, and that's going to be assessed. But what has to happen is there has to be a debt sustainability analysis. There has to be an analysis of their participation in this broader conditional program. There are just lots of different things that have to be assessed. And the decision could be, at any point in time, that they don't meet one or more of these criteria. And it's not clear to me that any of these criteria are as easily identifiable as they asked for the program, they remain in the market, they exist in a conditionality arrangement, right? Those are institutional and discrete things. So the options for any country that's denied TPI support to say this is a political decision, we met all the requirements and you denied us because you don't like us, strike me as too huge. There are just too many easy arguments to make. And this gets to the second point. You know, I mean, when Maria talks about, you know, the ECB pulling the plug on Greece, let's not kid ourselves. It was two discrete acts. One was to deny to pull the waiver on Greek sovereign debt for use as collateral in routine liquidity operations. That was one. And then to challenge the ability to extend emergency liquidity assistance to the banking system. That was another. Now, Greece stayed in, and so those two things could be forgotten by everybody but Yanni Varoufakis, right? But if Greece had crashed out because of either of these two things, that would have been the basis of the stab in the back, right? Because it would have been the ECB that crashed Greece out of the euro. And that makes me very uncomfortable. Those are discretionary choices that the Governing Council is required to make as it's constituted, but they have political consequences that need political cover. And so I'm apprehensive about TPI because TPI gives the appearance of too much discretion and too little political accountability for the Governing Council.
Maria.
And if I may, and also the other thing is that Greece did not have access to QE before the pandemic crisis, and actually right at the pandemic crisis there was a quick Governing Council meeting in which the Greek debt was accepted as collateral for QE, and that actually was the first time that Greece actually had access to monetary policy. In a very long time. I mean, that's, of course, an interesting issue. But I totally agree with you, and this is why if I have one comment on the design of the new instrument is that I would have preferred for the ECB not to make that assessment on the viability of the debt before it decides whether to give help or not. It should give it to another institution. Now, what other institution that is? We could talk about it, but I think I would have preferred that not to be at the discretion of the ECB. That is something that, because it is politically charged, and I think it is not the ECB's, it actually destroys a little bit of her gravitas in this respect, because it will be coming into political space, in my view, and I totally agree with Erik on that.
Rolf, you wanted to add something?
Yes. My lesson from the past crisis, and when you refer to Greece, is that, and the insight that went into the construction of the OMT instrument of the ECB, is the insight that monetary policy alone cannot do it. If a country has a fundamental vulnerability, you need to address it.
Sure.
And you need reforms. And that is why, with OMT, what you saw and what was the thinking also at the time, as far as I can say from the outside, if we have a country that has some structural weaknesses, we want to have the safeguard of an ESM facility that those structural weaknesses are addressed. That is the safeguard that was intended to be there, because otherwise you're basically throwing money, so to speak, at a country that cannot overcome its problems. OMT still exists. And I will not comment any further. I really feel also pity with Governor Knot, who must be sitting on a hot chair in order to kind of react to all of this. But from an ESM perspective, what I can say, the far we understand it, OMT still exists. It exists next to TPI. If you look at the conditions that were expressed for TPI, they are relatively close to what ESM conditions are for a precautionary credit line. For us, a precautionary credit line is viable as a possibility when a country is fundamentally sound. If it is not sound, it needs to adjust. And from there is where I see, from our perspective, a transgression of us not being involved to us being involved potentially under OMT. That would be my way of looking at it.
I have one final question about TPI, Erik. maybe you can comment on this. Is there a way out for the ECB once it has activated the TPI? Because if a country does not meet required conditions and the ECB withdraws support, then that will cause exactly what the central bank aims not to happen. That stress on financial markets, sharp interest rate movements, and that's exactly what the ECB wants to avoid. So is there a way out once activated?
So let's roll this back and say, is this the only thing where the ECB is in a position right now because of its unconventional monetary policy stance where it's hard to figure out where the way out is, right? And I would say, when the first time they tried to pull off the targeted long-term real interest rate or refinancing operations and they discovered that these were being used to meet minimum liquidity requirements, they were like, uh-oh, there's no easy way out here. We have to extend a new round of these things. And they're facing that situation right now because the TLTROs are supposed to come off in June. And how do we do that without pulling too much liquidity out of the banking system? Likewise, the first line of defense is not TPI. The first line of defense is the reinvestment of maturing principal on PEP holdings, right? Well, what happens if they run down the PEP holdings? And then we have no first line of defense. So now this is another thing. We don't want to keep them forever, but we can't run them down. And then there's the problem that as they're raising interest rates really high, it's not really transmitting through the economy, the financial economy. Why? Because there's so much liquidity out there because they have these huge balance sheets and they've got all this stuff going on. So I think the ECB is in a very tight situation, and TPI makes it better, but it doesn't eliminate the difficulty of getting out of this situation to begin with. And I'm just going to put an advertisement in. I just read a really good book by Jajit Chadha, who's the head of the National Institute for Economic and Social Research, called The Money Minders, that formalizes what Maria was talking about the difficulty of setting your policy instruments in conditions of uncertainty. And you have a real trade-off between where you can be in terms of your instrument setting and how much uncertainty you can handle. And unfortunately, the ECB is caught in that trade-off as well, and it makes it very, very difficult to make policy decisions. So I don't envy the Governing Council when it has to meet.
Okay. You mentioned her already, Isabel Schnabel, member of the Executive Board of the ECB. She suggested last year in a speech that the ECB's policy may lead to inequality as an unintended consequence. The divide between the haves and have-nots is deepening. Erik, what's the effect of current European policy, monetary policy, on the distribution of income and wealth?
So I think we're so shrouded in uncertainty. Even when they do large monetary policy changes, it's very difficult ex ante to anticipate who's going to win and who's going to lose. So I think that's a story that fiscal policymakers need to address after the fact. They look at people who are suffering and they give them assistance as needed. I think that's the only way that we can go about this. We can't ask monetary policy to play an explicitly distributive game because we don't want monetary policymakers to be thinking about distribution ex ante before the fact. Because if we did ask them to think about that, we would have to give them an awful lot more political cover, which is what Paul Tucker's argument, former deputy governor of the Bank of England, that's what Paul Tucker's argument is. I mean, so I could just stop there.
Let me just add. I mean, if you were to ask the question of distribution, I think we should start with the distribution effects of inflation, because I think this is the bigger problem to solve, and there is no doubt of that. And we have some numbers at Bruegel which we show that the burden on the low-income countries is disproportionate by comparison to the high and middle and the high income, or the inflationary impact. You feel it a lot more if you're in the low households than if you are on the upper quartiles. So I think that's the thing to solve now. And here I'm totally with Erik. I mean, we cannot really ask the central bank to solve that problem as well. Apart from the one target, one rule, Tinbergen rule, there's just so many other things that need to happen. Fiscal policy has got a distributional component here, and social policies are the ones that need to come in and pick up some of the effects of the unnecessary consequences of interest rates going up.
So that shouldn't be, the ECB is not the right actor?
No. No, these are the secondary effects. But I mean, you know, we ask them to do greening policy, the climate issues. I mean, there's growth, there's financial fragmentation. You know, there are other instruments out there that should be used for distribution aspect.
I want to remind you that you can also ask questions. So if you have a question for our panel, please raise your hand and we will bring you the mic. Also, people watching online, you can type your question in the YouTube chat. I see a hand here on the left. If you have, we're gonna get the mic. Yes. Oh, take care. There.
Oh, sorry.
Thank you. My name is Clement Skoll. I'm professor of monetary and macroeconomics here in Maastricht. I'm fully with Erik in saying that ECB is between a rock and a hard place in its policy trade-offs. I would like to ask two questions. One is on the monetary policy tightening that has happened. And the question actually is it really monetary tightening, or is it just a symbolic, let's say, credibility generating policy move, in the sense that there is an enormous amount of liquidity and real interest rates are so blatantly negative that an increase of even 75 basis points is, the question is how much of an impact will that have in the real economy? The other one is on the TPI. So Erik mentioned the problem of refusing, let's say, support for a country, but the knife cuts two edges. So you could also say there's a problem of giving support. So also that might be seen as a political move. And what has been mostly left out of discussion is the endogenous role of financial markets. So they could actually test when the ECB wants to do something with TPI and when not. And then, of course, there's always going to be speculation. So isn't that an extra danger? Thank you.
Who wants to take these questions? Maria, you first?
Thank you, Clemens. On your first question, I actually think you're right. The 75 points is not going to do it. The real interest rates are very, very negative, unlike the US, where there's consecutive increases, and then actually now we are in positive territory. But in the euro area, indeed, I mean, we need to see huge increases before we can even attempt to come to what we think is the neutral rate. So I think also you're right in saying that it is much more of a credibility issue, and I think I started with that by saying we are now in a place where with 9% inflation, you just cannot afford not to do something. So I think there is an element that you've got to back it with numbers, obviously, and the ECB has done a tremendous job in giving us numbers, and the speech that you quoted, I think, is a very nice example of justifying why we're doing what we're doing. Interesting on the TPI, I haven't thought about that. I think in my markets testing the ECB, I think markets will always be testing that. I don't know that the TPI is one exceptional instrument they will want to test. On the other hand, I will say that it is a very specific euro area problem. No other country has got this financial fragmentation issue. So it could very well be that the markets take a view, let's find out what this is. I don't know. I hope not.
Erik.
Clarence, the question you're asking about whether this is really monetary tightening assumes that we agree on what the mechanism is for transmitting monetary policy into real economic activity. If the mechanism is through the investment or consumption channel, we've got an 18-month lag anyway, right? So, yeah, we were going to have to ratchet it up, and then we'll have to wait and see if it works. If the investment is through the expectations channel, then absolutely, it's a symbolic act, but the symbolic act is the monetary tightening transmission mechanism. So I think, and here I think this is what the Bank of England sort of missed out on. Giving an announcement that you're not going to do anything is probably not worth giving an announcement, because it's not quite clear what they're trying to communicate to shape expectations. And so I think what the ECB is doing is, and I think this also explains the cognitive dissonance on forward guidance, because the ECB is not saying we're going to do this as a means of forward guidance, raise interest rates further. They're trying to get us to discount those interest rate increases now so that we can have an immediate consequence. And the second thing, so I started my career studying macroeconomic policy in Belgium and the Netherlands, right? And I only do this central bank monetary union stuff because nobody would pay me to talk about Belgium and the Netherlands. And so I'm acutely aware that the perceptions are very different about who's deserving and who is not. And that kind of political dynamic is something that we're going to have to wrestle with.
Question here at the front, and after that we'll come to you.
Maybe could I
Rolf
just
first,
make before one quick point on our second question. So I think as ESM, we are regular in the market. We have to issue our bonds, we have to invest the capital. So we are market participants. And from that perspective, as a first point, I can note that apparently ECB policy is working, right? So because we see spreads being rather well behaved. There is some widening, but that is what one should expect, but no spiraling whatsoever. So markets are relatively well behaved. And that is the first point, I think, for market participants important to note. Second point was your question, can it be tested? Will it be tested? My guess is that given the macro environment that we are in, I think there is quite some probability that it might be tested because the macro environment is a very difficult one where also fiscal policy choices have to be taken. So from that perspective, I think it's very important that governments do have and keep kind of a credible fiscal policy stance. That will be crucial in order for the instrument not to be seriously tested.
And where do you think will the markets first test it? Will that be Italy? Because TPI was soon dubbed to protect Italy?
From my perspective, the environment that we are in, we can credibly and responsibly manage what I would see as a possible fiscal path, forward-looking, and there are some do's and don'ts in fiscal policy. The do's is, and we talked about that before, focus on those that are mostly affected by the pandemic, by the inflation and energy prices, support the companies, focus also on the transition of the economy. The don'ts, and also Christine Lagarde, I understand, has formulated it very clearly, don't do broad-based demand support, don't do broad-based price support that would further stimulate inflation. But that still opens a fiscal policy path that one can credibly take. And then I'm not here to predict who, so to speak, will make a policy mistake or will kind of come up with a policy plan that may lack credibility. I don't know. I mean, so far, risk governments, I think, have, to a large extent, tried to embody this kind of responsibility, but the environment will become more difficult because growth will be less. Till Q2 this year, growth has exceeded expectations, actually, and that gave some fiscal space. It was important not to kind of completely use that space and then be driven into pro-cyclical policies next years. So I think in that environment that we will be facing, credibility of fiscal policy will remain very important.
Erik, a quick follow-up, because I know you live in Italy, and I do want to address Italy because of the elections last weekend. Why are the recent internal political developments in Italy so important when it comes to this instrument?
I think, Rolf can't say this, but since I live in Italy, I can, because everybody in Italy is acutely aware that there is a potential for market speculation against Italian sovereign debt. I mean, they're just acutely aware of that. And no one is more aware than Giorgia Meloni. And she's been soft-playing this and talking incessantly with Mario Draghi about it, and been very open in the media that the last thing she can afford is a speculative attack on the country, right? Unfortunately, that's not the media Matteo Salvini reads, so he hadn't got the message, and he was saying all kinds of things that were off message. It's like he got this playbook on fiscal rules and decided that he was going to announce the opposite. But since he only got under 9% of the vote, I think we can hope at least that he's in the box, even if he's in the right-wing coalition. And so long as he's in the box, I think we're okay, right? I mean, I don't know, but I think we're okay. And so we have to, I just published a piece in Foreign Affairs on making this argument, which they then said, and that's why we should root for Giorgia Meloni, which made me very unpopular in Italy, but except for among the 26%. But I think the point is that everything that Rolf just said, they're aware of, and they want to avoid this kind of a negative attention that Clarence suggested might exist.
Clear. Question here in front.
Well, thank you very much for a really interesting discussion. Perhaps we've been focusing a little bit more on the monetary policy than the fiscal policy. And in general, of course, in times of crisis, there's a tendency to treat symptoms in the short run rather than treat the disease itself. I agree with you, Rolf. Europe is in a much better position now than we were during the Euro crisis. We might have a situation in a few years where we are much less dependent on importing energy. But we're also facing a number of challenges like the demographic challenges that's going to influence our economy. We might see a situation of deglobalization where Europe is much harder hit than others. We do not have a continent that is strong on entrepreneurship and innovation. So my general question to you is, how do you see the continent in a couple of years? Because we need to, at some point, get out of this crisis moment and the high interest rates and be back at stimulating the European economy.
If I may, a big question. Just a few thoughts, like attempt an answer. I mean, I don't have a full answer. So on the, I don't actually believe that Europe is not strong in innovation. I think we have very good education systems. We have big research and development. We have innovation. We have a huge number of startups, and there things go wrong. After that, things go wrong. We don't have the mergers and acquisitions. US firms and Chinese firms acquire European firms at the rate of 2 to 1, in particular in some sectors, finance and pharmaceuticals. The IT sector in Europe and you know, the semiconductor industries is very much nascent. So there are disadvantages that need to be resolved. Where I think, and there's one thing I would root for, is we need the financing. Europe doesn't have a good financing model. We have a bank-based model, but a bank-based model, because of all the regulations that we'll have, will not take the necessary risks to meet the transitions of the type you described, including the green transition. We need much more capital in Europe, and you know, that's why I would, together with completing the banking union, I would urge us to think of ways of bringing more liquid capital in Europe.
Clear. Question from Mr. Klaas Knot.
Well, not so much a question, but I thought that, I mean, having listened to the debate on TPI, that there are so many questions out there that I thought maybe it's helpful if I try to give a little bit of my take on it. First of all the issues that you identified, I can assure you have also surfaced at the ECB table before we designed the instrument. So I think it shows that this is a very complicated situation to be in. And I fully understand that everybody outside the ECB would want to know when are they going to trigger this instrument or that, what are the conditions, etc. But having been now at this table for over 11 years, every crisis is different from the previous one. So it doesn't make any sense to talk in advance under what conditions you're going to do, because you know that the next crisis is again going to be different than the previous one. Secondly, there is actually value in something like constructive ambiguity, that you sort of try to maintain as much two-sided risk as possible. So my take on this is that, yes, there are these self-fulfilling spirals in bond markets that if they occur, the ECB is the only game in town, the only party that has both the balance sheet size and the swiftness of decision-making to respond. Right. If these occur, we now have a very rich toolbox that consists of no less than 3 instruments. We have the PEP, reinvestment flexibility, we have the TPI, we have the OMT, very important. All 3 instruments are there. And I think that's the best you can do as a central bank, to make sure that you have a very rich toolbox at your availability. Which of the 3 tools we will use? We're not going to say ex ante, but we have a lot of tools, so we have a lot of optionality that we have created for ourselves. I would say that if the problem is one of one country, one specific bond market only, then intuitively I would think that the OMT is more appropriate than the TPI, which is more a program for if there are wide-ranging problems with monetary transmission in multiple places in the euro area. But other than that, we will simply have to see what problem we are being confronted with. And then I think it helps ex ante if you have as many tools available to deal with the problem. And I can even say that if the 3 tools do not suffice, we'll design a 4th one.
Is there already one in the making? Please bring back the mic.
Can I?
Yeah. Well, okay.
Can I maybe make one additional point also to the previous question, to take that up again? I think what you say is absolutely right, and what we also need to take into account here, that what I talked before is the terms of trade shock and our wealth and income being exported. And this is something that actually put Europe at a relative disadvantage compared to other regions, compared to the US, for example, that has much less of terms of trade shock. So I think indeed this need to be competitive, remain competitive, and work on the productive structure is actually strengthening now. I still think that Europe is in a relatively strong position with the next generation EU that we have started to run, and I think pretty successfully. And this will still keep, so to speak, governments also very busy in deploying all those structural reforms that they want to do in order to reform the economies and make them fit for the future. But obviously there is a much more that needs to come. Capital market union and having proper financing is one of them. So I think it's a very deep and valid point that where more initiatives are needed.
And we will talk about the banking union and the capital markets union in our final panel. Maria, I would like to give you the opportunity to react to Dr. Knot.
Just one comment that arose to me. It's absolutely, I think it's a great idea to have many instruments for different occasions, and I also buy the idea that you cannot, ex ante, say how you're going to react to a shock that you haven't even seen yet. But one thing I will say is that the OMT is primarily a crisis tool, and therefore you assume that if you're considering OMT for countries because there is a crisis, whereas I think the TPI was designed much more for managing markets rather than a crisis. So I think the signal that you would be giving if a country came into that position and you say now it's an OMT type of situation, then you're really talking about a country in crisis with an ESM program, with conditionality, with monitoring, and 10 years later you come out of it. Whereas a TPI is a very different instrument in this respect, even if it's applied the same way. So there is a that is of course a matter of discussion, but I think I see the instruments rather differently.
Sorry, I cannot, but there is a misconception here in the sense that I think, please be mindful that our toolbox is flexible. So the pandemic support was modeled on the back of the an enhanced condition credit line, which would in principle allow the ECB to come in with OMT. It's not said that each and every country that, so to speak, knocks on the door of the ESM will have a 10-year adjustment program. Remember what we did in Spain. In Spain, there was the financial sector, the banking sector that had a problem. We had a banking sector-focused program for 1.5 years, which was the time needed to sort out the problems in the banking sector. No other macro conditionality in the broad sense that was directly meant for this intervention. So I just want to prevent this idea that ESM means necessarily a Greek-type adjustment program. It does not. There is flexibility.
Thank you. Eric.
Just very quick on the one country thing with OMT, which I understand completely. The problem with qualification for OMT is the order of operations. You've got to stay in the market, you've got to ask for assistance, you've got to join a program. I think by the time the Italian government finally gets its head around the idea that it needs to join a program, I wonder if it will still be in the markets. That's my concern, right? That it would just crash out before they could make the decision.
Yeah, Mr. Knot.
I think Rolf made a very important point. The word program is being used sort of as an analogy to what happened to Greece, right? Because that's why ESM is so toxic. Let's face it. It's not the other 3 programs that were hugely successful. It's the Greek program. The OMT also has as an entry a precautionary credit line from the ESM, so not a full program. The point that Rolf made, that the conditionality for a precautionary ESM line is the same ex ante, only ex ante conditionality than is in the TPI. So a lot of this, well, aversion to ESM is really hot air.
But if they are so
Maria,
similar,
we have to close this panel. Sorry, we have, yeah, you can discuss it during the coffee break. I want to thank all of you, my guests, Maria Demertzis, Erik Jones, and Rolf Strauch. Thank you so much. Please.